The first stage of accounting cycle is during the accounting period. From the first day to the last day of accounting period, there are lots of transactions or events occurred during an accounting period. And these transactions and events should be well documented according to accounting standards. So basically, we are going to analyze these documents and record these transactions or events appropriately. Before we start analyzing transactions or events, let's first categorize all the events or transactions. All the economic events can be classified into two categories. One is external events. In accounting, events and transactions are equivalent. So these external transactions or events are related to the company with another entities or individuals. For example, the transaction can be the company issue stock to the shareholders, owners, or borrow money from bank or creditors, or pay salaries to the employees, or buy material from the suppliers and sell the goods to their customers, so on and so forth. Because there's another entity or individual involved, right? Usually there will be documents to record this transaction in different format. In other words, we have evidence of external transaction. So the analysis of this transaction is straightforward and easier than the other one, internal transaction or events. These transactions or events are mostly the adjustment to the financial statements. As accountants, we should have experience to identify these internal transactions and events and record them appropriately. As I mentioned in the slide 19, most internal transactions or events will be recorded as adjusting journal entry or their adjustments. The example is the depreciation to the fixed assets. During an accounting period, for example, 3 months, the company's machine is subject to normal wear and tear. So the book value of fixed assets should be written down accordingly, and this is the definition of depreciation. This transaction or event is not as evident as external transactions. So we should identify these internal events or transactions and make the journal entries accordingly. Other examples regarding the internal events and transactions including the amortization to the intangible assets, depletion to the natural resources. The reason we should identify these economic events because these events or transactions have impact on the company's financial position. So what does financial position mean? Actually, balance sheet captures the financial position of a company. This equation I underscored is the accounting equation. Assets equals to liabilities and stockholders' equity. This equation also represents the balance sheet. The change in financial position also means the change in accounting equation or balance sheet. So the economic events that change the firm's financial position means they will change the balance sheet. The balance sheet is prepared based on accounting equation. Okay, so accounting equation is a mathematical equation. The total assets equals to the liabilities and the stockholders' equity. In this class, I use A to represent assets, L represents liability, SE represents stockholders' equity. And we use this a lot for our transaction analysis. On the left side of this equation, assets, they represent different types of economic resources. For example, cash, receivables, inventory, short-term investments. Long-term assets include long-term investments, property, plant, and equipment. Other intangible assets etc. These economic resources are required for the company's day-to-day operating activities. On the other side of equations represents the claim to the resources. These claims are either from the creditors reported as liability or from the owner reported as shareholders' equity. Okay. Let me give you an example. This simple example is to illustrate how accounting equation works. If you buy a car for $30,000, but you don't have $30,000, you only have $5,000 available, this is your down payment. The rest, $25,000, is your loan from the bank. You are the owner, but you only have equity $5,000. The bank has a lien, right? So this is the equation. For the total $30,000 assets, you as owner only has $5,000 claim, while the bank, your creditor, your lender, has $25,000 claim to the car. So that's why before you pay off your loan, you will not receive the title of the car. So that's an example of a accounting equation. Any resources basically are provided by either creditors or the owners. For each transaction or event, it has a dual effect on the accounting equation or the balance sheet, okay? Because balance sheet is prepared based on accounting equation. What does dual effect mean? For each transaction or events, when we record this transaction, there must be at least two accounts to be involved or affected. The dual effect also refers to the double entry system. Which is different from the single entry system. Let me give you an example. When I was a kid, I occasionally receive some pocket money from my parents. So when I get $10 or $20, I just recorded this as addition to my savings. I know I will deduct what I spend. This is a single entry system. I only record the change in the assets I have. But for double entry system or dual effect, we record two. I will show you the dual effect in the following examples. Let's take a look at this example. An attorney invested $50,000 to open a law office. Okay, so the law office is a business or the company, while attorney is owner because he or she invests the money to start this business. What's the impact on the financial position? From the perspective of the law office, it received $50,000 cash, which is an asset. So the assets increase 50 grand. And for the single entry system, we may just record the addition to the law office asset. But for the dual effect or a double entry system, we also record the claims. So there are also $50,000 equity, which represents the claim of the owner, the attorney. So that's a double entry system. In this transaction or this event has dual effect on assets and equity. The two accounts affected are cash, and this one is common stock and additional paid-in capital, which are two accounts to represent the contribution from the owner, while common stock represents the bar value of the equity. Additional paid-in capital is the difference between total contribution and the bar value. For the partnership or sole proprietorship business, we just record investment by owner. Different accounts, but it refers to the same thing. Okay, these both represents the contribution by the owners. Apply to different type of business. Next, $40,000 was borrowed from a bank. This is a transaction between the bank and the law office, not the owner the attorney. Yeah, basically, we know the law office borrow money from the bank. So the money is the assets, right? So law office now has additional $40,000 cash. We should also record the claim of the bank, $40,000. The bank has no intention to become the owner or shareholders of the law office, right? Yeah, it just lend money to the law office and expect the principal and interest are returned. So the bank is a creditor or lender, so recorded as liability. This transaction has impact on two elements. One is assets, the other is liabilities. Well, the accounts of each element affected is cash and notes payable. Yeah, for the law office, it has additional cash assets, while it also has liabilities. Right now, after these two transactions, you know there are total $90,000 cash received, but 50 from the owner, 40 from the bank, the creditor. Next, supplies costing $3,000 was purchased on account. So this is transaction between the law office and the supplier. The supplier provide office supplies cost $3,000. Because it was a purchase on account, so there's no cash payment right now. So there's no impact on the cash account. So in this case, the law office received $3,000 supply, which is an asset, right? $3,000 increase. Well, because it is purchased on account, there will be a payable in the future. At the time of this transaction, we only record the liability to the supplier, no cash payments. This liability accounts payable is different from the bank's notes payable. For banks, it lends money to the company for interest income, okay? But for the supplier, this liability is the credit offered by the supplier to the law office. The purpose is not to earn interest. Instead, it is to promote the sales of the supply to the law office. This is a very common B2B transaction. The supplier allows the company to defer the payment for a few days or weeks, even months. The zero effect is on supply accounts, which is an asset, while accounts payable, I use AP to represent accounts payable. Again, it has zero effect on two accounts. And also, for sure, these transactions have impact on the firm's financial position. We see the financial position changes. If this purchase was not on account, it was in cash. Think about it. What is the difference we can observe? Because this transaction is in cash, right? So there will no liabilities. Instead, the company pays $3,000 instantly when the supply is delivered. For the transaction analysis, you should read the description of transaction very carefully. A single word difference may change the impact on the financial statements. If this is the case, accounts affected are cash, $3,000 decrease, supply. This transaction does not change the amount of both sides of balance sheet, but it just changed the format of assets. Again, this also represents the change in the financial position. Next, because the law office is to provide service, right? So service is a product. So service were performed on account. Again, we see on account for $10,000. So because the service has been performed according to the revenue recognition principle, the company should recognize revenue. With revenue increase, it also equivalent to the shareholders' equity increase. So shareholders' equity increased 10,000. Because it is on account, that means the customer deferred the payment. Instead, the law office will record another asset. Instead, accounts receivable. Accounts receivable, this represents an asset. This is a contract between the law office and the customer. So the customer will make cash payments later. Its value relies on the high probability of future cash receipts from customer. In this transaction, there's two accounts affected. One is accounts receivable. I use AR to represent accounts receivable. Another is revenue. Why I use revenue? Yeah, so actually revenue, here I can also use retained earnings. Maybe this is the first time you see these words, but don't worry, you will get familiar with them later. Either to record a revenue or retained earnings is equivalent regarding the impact on the financial position. We use revenue because later we need to use revenue to prepare income statement. Later, I will talk about how to close the revenue account to the retained earnings, or how to transfer the balance of revenue to the retained earnings account. Number 5, salaries of 5,000 was paid to employees. Because salary means this is an expense. So expense different from revenue, which increase the stockholders' equity. Expense reduce stockholders' equity. Okay, so stockholders' equity reduce 5,000 because this is salary paid. That means there is a cash outflow. So the assets reduce because the payment to the employee, while an expense is recognized. Now you will see this transaction also has dual effect. One is cash, an asset account. The other is expense, which will be reported in the income statement, but it is also related to the retained earnings. Different from the revenue, which increase retained earnings, expense actually reduce retained earnings. Or record an expense is equivalent to the reduction in the retained earnings. This transaction has impact on the financial position. Next, $500 utility were incurred but not paid. So that implies there's $500 utility expense incurred, but not paid. That means the payment is deferred. Okay, so first expense, we know similar to the salary expense, we will recognize $500 expense, which reduces the stockholders' equity. So here is a negative sign. Because $500 expense was not paid, so it represents a liability to the utility company. So the accounts payable to the utility company as a liability increase, 500. You will see this transaction have impact on liabilities and stockholders' equity. The two accounts that are affected, the accounts payable. This is accounts payable to the utility company, and the other one is expense. If I change this description, the utility were incurred and paid. Think about it. Because it is paid, there will be no liability, right? Instead, because there's payments, so there will be a cash outflow or payments. Again, this also keep the accounting equation balanced. Both sides negative 500. But the original example, this increase 500, this decrease 500. So the accounting equation is a very important tool for the initial transaction analysis. But when you get very familiar with these, transactions, you don't need it. Okay, it become a language by itself. But now we just start learning. We need accounting equation as assistant. This $1,000 was paid on account to the vendor. This transaction implies this is a payment to the vendor. So there will be $1,000 cash outflow. This payment is for the prior transaction on account. This payment is not for a purchase. It is to pay off prior accounts payable. So accounts payable reduce $1,000. Okay, so both sides reduce $1,000. The accounting equation is still balanced. The balance sheet is still balanced. So actually, the number 7 is related to the prior transaction. This one. Remember here, the vendor provides supply $3,000, while the $3,000 purchase were on account. And number 7, the law office pay $1,000 out of the $3,000. It partially paid off is accounts payable. Oh, there's still $2,000 accounts payable left for future payments. In the prior 7 transactions, I mentioned the accounting equation and some accounts to you. Let me explain their relationship. First, the accounting equation is assets equals to the sum of liabilities and stockholders' equity. As a review, the assets represents the economic resources, while liabilities represents the claim from creditors, and stockholders' equity represents claim from the owner. And the stockholders' equity has 2 components. One is paid-in capital, which represents the contributed capital. This is a contribution from the owners or shareholders. For corporation, this represents the capital raised from the primary market through IPO or SEO. The other account is retained earnings. Retained earnings represents accumulated profits from prior accounting periods, after subtracting any dividends declared and paid. The retained earnings account also represents the unpaid accumulated profits. For each accounting cycle, the company's operating will be recorded in the income statement. In a simple version, the income statement represents the difference between total revenue and gains and the losses and expenses. So their difference is net income, which represents the profits. And who has a claim to the profits? The owners or the shareholders. The liabilities represents the claim from the creditors. The creditors have the claim to the assets for principal and interest, and the interest is considered as an expense when we prepare income statement before we get the bottom line, the profits. The net income is a result after deducting all the expenses from revenue and gains, including interest expense, while only shareholders or the owner has claim to the profits. If a company has net income, it indicates the total revenue and gains is greater than the sum of expense and losses. Conversely, if the total expense and losses is greater than the sum of revenue and gains, the company will have net loss. Here we just assume the company is profitable in the prior accounting periods, so these profits will be accumulated in this account, retained earnings, after subtracting dividend. A dividend is not an expense, because before we get net income or net loss, we've already subtract all the expenses and losses. 2 outlets of net income. One is pay dividend to the owner, because owner has a claim to the net income, right? So the company can decide to pay the profits to the shareholders as dividend. This usually represents the cash dividend. The other is reinvest in the company and record it as retained earnings. We can call retained earnings as unpaid profit. or earnings. So the retained earnings represents prior accounting period's total earnings or profits subtract accumulated dividends. So difference is the total accumulated unpaid profits. Different from the contributed capital, retained earnings is the earned capital. The source is from prior profits reported in the income statement. The income statement basically only records these two. The bottom line is difference of these two. Depends on which one is greater. If the revenue or gains is greater than the expense or losses, that will be net income, otherwise net loss. It is possible that the company will have negative retained earnings because the company does not make money but keep incurring net loss from a prior accounting period. In some financial statement, you will see a deficit instead of retained earnings. The double entry system also refers to the dual effect I mentioned in the prior example, all the transactions. So each transaction or event, when we record them, it has impact on financial positions. That's the reason we record them, right? And also it has dual effect on the accounting equation on the balance sheet. And also the impact will be recorded in the accounts. So there will be at least two accounts affected because of dual effect. Sometimes one transaction may have impact on three accounts or more. But here, because I haven't introduced debit and credit, right? So I use a number of accounts. So actually dual effect means we will record debit and credit. We will debit one account and credit the other account. Okay, but right now I haven't used debit and credit, these two terms, in the examples. So I use two accounts instead. In summary, the double entry system has impact on at least two accounts, and at least one account will be debit or credit. Now I just stop here as part of transaction analysis. The general ledger and T accounts I will introduce later. And for the general ledger and T accounts, that's related to the posting or step 4. Now we focus on the transaction analysis to reduce confusion. I will go back to these slides later.